Okay, so we are here today to talk to Wendell Jones, the serial CFO, about regional center independent audits, independent reviews and audits. So I will bring up your PowerPoint, Wendell.
Right?
Wendell, do you want to tell us a little bit about yourself before we get started?
Most certainly. I have worked both as an auditor in the beginning of my career and on the other side, engaging auditors for probably the last 20 years of my career. And by doing that, it's giving me the opportunity to understand what is in an audit, what you're looking for, and take the, if you will, the problems out of the audit process and to simplify what needs to happen. As it relates to the regional centers sent out a standardized letter to all of their vendors indicating what was required. But you really have to delve into that letter to see what they're really saying. And the first point is they say effective February 1st, 2018. So what that means, and they also, the amounts that they use for differentiating between an audit and a review are based on their fiscal year and not your calendar year. So what that really means is if we start off and we go from looking at their schedule, and I'm reading it as we speak. If we look from July of 18 through June of 19, that would be the initial period that they're looking for, and with the differentiation being between 500,000 and 2 million in revenue. So we have to, when you look at your revenue, you've got to remember that they're looking at it on a fiscal year versus a calendar year, because that does make a difference. And the best way to get around it is just to do your audit or review for that calendar year starting in 2018. Again, if the amounts are high enough to require that, and then go forward from there. Once you've completed the first one, then you can immediately ask for an exemption for the next 2 years. Exemption is not mandatory. It's up to them on whether or not they accept it. But the point is, you've got to get that process started because it's a very defined process.
Okay, all right. Well, that's something I didn't know. I thought that people went by their year, not what the regional center did. So that's good to know. All right, here, let me pull up your PowerPoint.
You know? So now, again, if we look at the components of an audit, and even before the independent review and audit, what I typically tell people is the first thing you want to do is take a look at your own accounting system. Most of the vendors that I've met with have QuickBooks, which is the simplest one to do. However, I've seen some that don't have an accounting system, some that are just using basically their tax returns, which is a component of an audit, but far from what you need in order to have a successful audit or review. So my first comment to most folks is take a real good look at your accounting system and make sure that you're capturing all the dollars that you're spending that's coming from the regional center. What's the bottom line? They're looking to make sure that you can account for the dollars you've received. So we've got to do that. And to me, regardless of whether you do a review or an audit, you have to have that in place or you're going to have problems in the future regardless. Now,
Okay.
what's the difference? An independent review is for a vendor who has $500 to $2 million in revenue. It's not as onerous as an audit. And a financial audit is a review of your financial statements to ensure that what you're providing in your reports are accurate. So what the auditor or reviewer is looking for is to make sure that you have supporting documentation for any numbers that are in your accounting system. And by that, I mean your trial balance, your P&L. You're going to have a number for, say, December 31st. And for that number that's in your trial balance, you have to have support for that. So what I typically do is I ask the question, what do you have to support $100,000 in payroll expense? Well, if you have a payroll system, then obviously that information is captured. If you don't utilize a payroll system, then you want to make sure you have information that substantiates those dollars being spent. I'm going to keep hammering on that point. Dollars being spent. That's what the regional center is primarily interested
Okay. And then an audit.
in. An audit is a little more onerous because what the audit firm is saying is that we've reviewed the financial statements of ABC vendor, And we feel that those numbers fairly represent what has gone on. So it's a next step up. In a review, they're just reviewing. If you've got most of what should be there, you're okay. An audit, it's more onerous because they don't want to put their name on it unless they know that everything you've shown them or provided to them is legitimate.
Okay. Okay, pre-audit.
This is what I had started talking about. First thing is identify the accounting system and get the review access. So first thing I always say is, okay, what do you use? If you use QuickBooks Online, it's simple. You just provide a login, and then the reviewer or the auditor can go in and look at the information themselves, which for you takes out less time. You don't have to put in the same amount of time because they have access. If you use QuickBooks Desktop, you're generating paper reports to them so that they then have to come back to you. And it's a lot more iterative process of going back and forth. The first step for the year to be either audited or reviewed, and I'm using those terms simultaneously on this slide, and look at the trial balance. What's the trial balance? The trial balance is a summary of all the transactions in that given year. And typically what I do is when I look at that, I can see if there are any red flags in the financial statements by looking at the trial balance. The revenue for most vendors is fairly straightforward because the revenue is coming from one source, the regional center. It's when you get into the expense side that there can be a lot more variability. And we want to make sure that what we're putting in there relates again to the revenue that you receive from the regional center.
So what are some of the red flags that you see in the trial balance?
Payroll,
Lack of payroll or
lack of payroll system documentation.
oh,
Everyone pays payroll, but they may not pay it in a timely fashion using their payroll system. For example, if you have ADP and you have a payroll on the 1st and 15th, it's relatively straightforward. There's no red flag because the information is going to be captured. If instead, let's say you weren't able to run payroll that month and you ran it manual checks, and that's when you have to make sure you have your supporting documentation in place so that there's not problems. That's where the red flag comes in for payroll. Another
oh,
big one that I see typically, rent or lack of rent. Are you paying rent? Well, if you own the property, you still want to have a rental agreement in place so that you can then indicate that rent should be paid to the property. It's another way, of course, of you also getting additional income. But there should be rent. If I don't see rent, that's a red flag.
mhm. Okay. Is there any other thing that you
The
look at?
only other thing to really emphasize is year-over-year anomalies. We're now auditing 2019, and 2019 you had 515,000 in revenue, and you lost $10,000. It's now 2019, and suddenly you're getting 1.5 million in revenue, and you're netting 300,000. Doesn't track because one of the things they look for is year to year. So you expect things to change in relationship to what you have in your base year. So you want to be very careful about doing things that don't really apply. And one of the things I always do when I go through it is there are things we take out. I'll look at it. Oh, well, that was for my daughter's school. I said, that's fine, but you can't have that in your financial statement. What you can have in that situation is you loaned yourself $5,000, and then what you paid that $5,000 is irrelevant to the regional center, as long as that loan is booked, is in your books. So I pull out all of those obvious personal things.
Mm-hmm. Okay.
And
Oh,
then last but not least, once the financial statements are in fairly good shape, we send it over. I introduce you to the CPA firm that does the audit and review, and you engage them to have the audit. What they do then is they first will ask you for obviously access to your accounting system. If it's online, as I said earlier, it's just the password. If it's not, they're going to want a file, the general ledger file, which is a fairly heavy file. But that's the two options because they're not going to just want paper.
Okay. And then do you act as a liaison between them and the client as they're going through the review
Yes,
or audit?
I'm available for that. What I try to do is if we do a good enough job cleaning it up front, then there's minimal involvement required from me unless they're questions. And the way it typically, when those questions crop up, is when Rojas, okay, you've engaged them. What's the next step they do? They send you a list of required documents. And as you go through that list, and I have a sample list that I usually review with each of the vendors, it lets you know the kinds of things they're looking for. That's where I try to get if there are any problems. That's where you tell me because I'm on your side. I'm not with the auditors. So I'll look at it and say, this doesn't look right. They're asking you for payroll. Do you have payroll? Do you have rental agreements, leasing, any attorney agreements, any of that sort of thing they're going to ask for. So we want to make sure those are available.
Okay. All right.
Planning and pre-work, making sure that the organization and environment are clearly understood. Everyone accounts for things differently. So we want to make sure that we understand how you're accounting for it so that when they do their analytical procedures, they're looking for risk. So if for example, in one particular category, you've got $2,000, that's not a high risk area. If instead there's an account where you've got $150,000 in expenses, that tends to be a higher risk area. So what the first thing they're trying to do is to determine where the risk areas are for them. And then that's where they really inquire and then look at potential fraud. Is there any potential fraud? They're not looking for fraud because they're not fraud auditors. But if they see that the environment lends itself to the potential for fraud, then we've got other issues we've got to deal with. Now, what would be an obvious one? You've got a checkbook, and 4 or 5 people have access to that checkbook. Well, that to me doesn't seem like a very good internal control and will lend itself to potential problems. And those are the kinds of things that you want to be wary of as you're moving forward, because they're looking at your control environment in order to determine what is and what is not risky.
Uh-huh.
Because again, they don't want to put their name on anything that's going to come back and bite.
Mm-hmm. Okay. And then you say here determine audit procedures by functional area. What does that mean?
You look at areas marketing, you look at admin versus what is actually client related. Some things that I've done in the past is as I meet with companies, with vendors, I suggest that maybe you want to change the name of that category to client or consumer, office supply or supplies. But there are things in your financial statements that you want to clearly show are consumer related. So that when they're in there, they're looking to make sure that 80% of those funds are being used on consumers. So if you've got a lot of generic categories, that makes their job harder, which in effect makes it harder on you. So what I try to do is you want to simplify it as much as possible for the auditors and to make it as automatic for them as you possibly can.
Mm-hmm. Okay. All right. That makes sense.
And that very last item is probably the key. And what I normally do is after I've met a couple of times with the vendor, I then give them a what I call a generic list of the kinds of documents they're going to ask you for. And what I do is I then meet with, if you have a bookkeeper, meet with that bookkeeper. If instead you're doing it yourself, meet with you. Let's go through and make sure that when they come back to ask for the specific ones related to your business, that we at least know the kinds of information they're going to be looking.
Okay. Okay.
This internal control environment is what I was alluding to earlier for risk. It's all they're trying to see is that do you have control? Do you have 5 credit cards out there, and people who aren't in the business have access to those credit cards? I mean, that's a very simple example, but it's not unusual. You want to minimize things that aren't under control. Do you do monthly bank statement reconciliation? That's a basic thing that every business should do. If you don't do that and don't have that to provide to them, that's a problem. So what I typically say is, look, if you haven't done it, it's okay. You can go back and do those retroactively. Let's do those before we talk with the auditors. And you can do those within QuickBooks or whatever the accounting system is in. The only thing I will stress, though, is I've met a couple of vendors who were using free software that they found on the internet. That is not going to get you through an audit or review. That's going to be problematic because most of those are really bill pay systems as opposed to accounting systems.
Okay. All right. Well, that's good to know.
Now, they're also going to ask about the organization structure because everyone is different. Some are nonprofits, some are for profit, some are C Corps, some are S Corps. All of that information they're going to want to know. So you want to make sure, however you're structured, that you adhere to whatever should be done. So, for example, if you're a C corp that is required to have a board of directors or something of that sort, you better make sure you have it. So you want to see how you organize yourself and make sure you're in compliance with that, because at the end of the day, all of this is for compliance.
Hmm. Okay.
Legal environment is straightforward. First thing I always look at is, how much in legal fees. If you have a minimal amount, they could care less. They just want to make sure that there's an agreement with the attorney who charged you and what they charge you for. If it's consumer related, then you're perfect. Then it easily falls into that consumer category. If it's something that's outside the realm of the consumer, my suggestion would be get it off your books, because again, the regional center wants to see we gave you money and you used it for our consumer. Period.
Okay. So, we have a lot of vendors that are hiring employment attorneys right now because the labor board is going out looking at people.
Yeah.
Would something like that be a red flag for them if they're paying for an attorney to deal with some labor issues? Because those don't really have to do with the consumers, but they
Well,
do have to do with the
but
program.
it is for the employees that are working for consumers, right? Is that what they're looking, or are they looking more in the
Yeah,
administrative? Yeah,
yeah.
that's fine. That's not only not a red flag, that's what I would expect to see.
Okay, so that's the kind of thing that you would want to see under legal.
Yeah, exactly.
Okay.
Now, if you sued your cousin because your cousin, loaned you some money, or you loaned them some money and they didn't pay you back, I don't want to see that in the books.
Okay. All right. I get the difference. Okay.
Okay, so now we signed our agreement. We're ready to go. Mohawks is ready to audit. The first thing, as I said, they're going to look at is do a risk assessment. They're going to see that they'll have your trial balance, so they'll see where the dollars are booked in your accounting records, and then they'll make a determination on where the riskier areas that they really want to look at. Then they're going to want to look at your tax returns to make sure that they're consistent with what you have in your books. Some people do them as two different things. I would recommend you don't do that, because what you want to do is make sure your tax returns are tight and flow out of your accounting records. The other thing you want to be careful about, where tax returns, a lot of people hire their tax guy to be their bookkeeper. Those are different functions. So where you get in problems is then when you try to get information from that tax person, the only information they can give you is information that's tax related. And that's not what you need for the audit or review.
If there is an inconsistency, were there any repercussions for the clients?
Repercussions from the regional center, no. From the IRS, yes. You,
Okay, and that would look like fines.
yeah, yeah, yeah. You want to be consistent. I mean, if you think there's something shaky in what you have done, the best thing is we clean that up prior to hiring the auditors. Because once they come in, they're only coming in to audit or review. They're not coming in to advise or to help. And you have to remember that.
Okay.
I've seen too many people where they try to get friendly with the auditor, thinking that makes a difference, and they end up getting burned on the back end. Because an auditor is, their professional reputation is more important to them than their friendship. The third item I talk about are client schedule. And that goes into that document list that I mentioned earlier. They're going to ask you for certain. They're going to ask you for a payroll register. They're going to ask you for copies of the bank reconciliation. They're going to ask you for any fixed asset ledgers in case the business bought a number of fixed assets. They're going to want to know what's your fixed asset policy. For example, if you buy laptops, typically I tell people just expensive, it's not worth it. But if you don't, and you haven't capitalized on your financial statements, then we need to see, what is it? We paid $2,500 for it. We're depreciating it over 3 years. You have to have those schedules to support that if that's what you're doing. The easiest thing is if you're working with a bookkeeper of any sort, they don't even have to be a good bookkeeper, but they know the basics, and we can get through things a lot easier. If you're not working with a bookkeeper, that's where it can get really sort of dicey, because a lot of times folks haven't really booked in their accounting records what they did over that period of time. And since we theoretically can go back to 18, that can be problematic.
Okay.
Now, the last one, I've been lucky enough that we haven't had to do that because there haven't been any findings. So there have been clean opinions. If we do the homework and legwork up front, then you don't have to deal with it on the back end. What you don't want is for them to issue a report to the regional center that basically says, in our opinion, these financial statements don't provide what they should provide. They don't give you a fair look at the organization. And to me, that last item means we didn't do our homework beforehand.
Okay.
Ready, next. So reporting. Okay, they've done all of their work. They've now reviewed, everything looks good to them. Then they'll prepare a draft report and management letter. The report is the report that will be going to the regional center. The management letter is any suggestions that they want to make to you to make things easier the next time through. Then the second item is really the key, the opinion. That's if it's an audit, you get an opinion. If it's a review, there is no opinion. So that's why I say it's a lot simpler. What they say in the opinion is what you want is that unqualified opinion. Everything looks good. We've looked at everything. We have, maybe they could have done this easier there and that, but nothing material has been found. A qualified opinion says, well, everything looks good except there was $30,000 that we can't account for. You don't want that. That's what we try to avoid. That's why we want that cleaned up front. And again, if there are any findings, recommendations, then they will discuss that with you. You are their client. Then once they're done, what we have, let's go to the next one.
That's it.
Well, the next step is you send a report. They send a report to the regional center. Once they send a report to the regional center, then they can ask for a 2-year exemption. The 2-year exemption now, you have to remember, it's not mandatory. They don't have to provide you with a 2-year exemption. But typically, from what I've seen, they have. That is the audit process in 30 minutes or less.
Okay. Did you have any more questions, Veronica?
Yeah, forgive me if this is obvious, but if you make over 500,000, are you guaranteed to be audited? Is it like an annual thing or?
Well, this is from between you and the regional center, not for a third party. So you're supposed to be reviewed or audited. If you don't, then there are repercussions that the regional center can utilize, their consequences. And more importantly, they could conceivably even bring DDS in. And DDS is a very onerous audit. It's not, right now you're hiring somebody that you're paying to audit or review. DDS comes in, they come in, 4 or 5 auditors deep, and you and your bookkeeper against that is a really mismatch in terms of skill set because they know accounting inside and out. And you don't want that. That's where they can come back and ask for money back. So you go through this process to avoid the DDS audit. If this was, excuse me, Denise, I can't remember correctly, maybe 10 years ago, it was all DDS audits as opposed to third-party audits. And then
Yeah.
they saw that wasn't cost effective. And now they really only bring in DDS if they're problem vendors or vendors aren't complying with the requirement.
Okay.
Yeah, and people will get a sanction, which means they can't take new clients if they
Yeah.
don't turn in their audit.
Okay.
So the key, Veronica, is to you should. There's no reason not to do it. It's the letter that went out was a standardized letter. They sent it out to all vendors, and they put the onus on you, the vendor, to do something. There's not any follow up. They're not coming and saying, "Well, have you done it yet?" They here's the requirement. It's on you to do. If you don't do it, then that's when the other consequences will come into play.
I see, but that letter is nothing to be intimidated by.
No, no. It's
Okay.
in fact, I've had who is it, Linda Lee? I talked to her a couple of times just to make sure, but she said, "No, it's just a standard letter we send out." I mean, it's
Okay.
not, it's not personalized. It's not going to this vendor versus that vendor. But nonetheless, I think most people, when they saw it, because they hadn't really paid attention to that requirement, it was alarming.
I see.
Yeah, whenever they say to you that you can't take new clients, people get freaked out.
Yeah, for sure.
And I could say out of all the people that I've met through Denise, I would say 90% were easily doable. There was a couple that I mentioned who were using free software, and I told them, you got to get an accounting system in there. I can't, you can't. If you're going to bake a cake, you need ingredients. If there are no ingredients there, I can't make the cake.
Yeah, so don't show up with a box of receipts.
Yeah, no, this is not that kind of situation.
Yeah.
People do that with their taxes, and that's fine. But when you're going to be audited or reviewed, you got to have something there in place.
Mhm.
And we can do it retroactive. That's not problematic. You just got to do it.
Mhm. Well, I think a lot of people are afraid
Yeah.
because they feel like they might have done something wrong and that they can't go back and fix it or,
Well,
I'm
that's
telling
where I try to put them at ease. That's why I'm here. If you did something wrong, tell me what you did, and then we can come up with a solution. Just don't try to hide it because it's going to be found. I mean, I've had some that I've seen money going out of the company that's not documented. So I said, okay, then what we'll do is we'll create a loan document where the owner has borrowed money from the company. There's nothing illegal about you borrowing money from your company, but then you have to have terms. You have to have an interest rate. How's it going to be repaid? A lot of times I've done them as long as 5 or 10 years out. Again, perfectly fine as long as you document it.
Mhm. Yeah, yeah. Same old adage.
Yeah, exactly. Document, 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 and don't try to hide it. I mean, we're here to help, and that's the key point. If I leave you with anything, we're here to help you through it. So just tell us what you've done, positively, negatively, and we can help you through it. We can't help you if you don't tell us.
Yeah. Okay. Any more questions?
No, I think you covered it.
Great.
So if you'd like to make an appointment to come and see Wendell, you can email me or give me a call at 510-331-0094. I think it's a wrap.
Thanks all.